Welcome to The Explainer. Today, we're going to dig into a classic business paradox, something that happens all the time. What happens when a company's profits are just exploding, but so are the risks? We're going to break down a real company that's caught right in the middle of this tug-of-war.
So, let's get right into our case study, a company called Apollo Microsystems, or AMS. Now, on the surface, this thing looks like an absolute dream investment. But as you're about to see, those big, flashy headline numbers, they almost never tell you the whole story.
Okay, so let's set the scene. It's early 2026, and AMS, a really important player in India's defense and aerospace industry, is posting numbers that are making everyone's head spin. This is the sizzle, the exciting part of the story that gets everyone talking.
Let's dive right into the numbers. Check this out. A 90.9% jump in net profit, year over year. I mean, that's not just good, it's absolutely explosive. This is exactly the kind of headline that can send a stock price to the moon.
And it's not just about the profit. If you look at this table, their revenue is up over 40%, and their profit margins have gotten way fatter. Seriously, on paper, this company looks like a perfect picture of health and unstoppable momentum.
So, what in the world is fueling all this incredible performance? Well, it turns out the story actually gets even better when you start looking at what they have planned for the future. I mean, just look at the sheer scale of their ambition here. They're pulling in huge new orders, building a massive new factory. They're even buying up other companies so they can build everything in-house. And they're starting to expand internationally. It's a textbook story of super aggressive strategic growth.
So up to this point, everything we're seeing points to a company that's just an unstoppable force. You've got record profits, a clear vision for the future, a massive order book. But this is where our real analysis begins. We have to ask one single, crucial question. All right, to really get the full picture, we have to look past the shiny headlines and start comparing AMS to its competition. And this, my friends, is where the story starts to get a lot more complicated.
And wow, okay, this slide right here is where the cracks really start to show. We're putting AMS side by side with its peers, data patterns and bar electronics, and looking at 4 key metrics. Just look at how much of an outlier AMS is in almost every single one. Take their receivable days. That's just how long it takes them to actually get paid. It's way, way higher than the industry standard.
First up, let's talk about the valuation, the price tag. The PE ratio tells you how much investors are willing to pay for every dollar of profit. At 115, investors are paying almost double for AMS's earnings compared to its rivals. That is a huge premium that basically prices in perfection. There is zero room for error.
And here is another major red flag. While its competitors are basically debt-free, AMS is using a pretty significant amount of borrowed money to fuel its growth. Now, debt isn't always a bad thing, but when your peers don't seem to need it, you've got to ask, why do you?
And here's the thing. This debt and that sky-high valuation, they aren't separate problems. They're actually part of a really high-risk financial strategy that has analysts watching this company like a hawk.
So where is this debt coming from? Well, that brings us to something called promoter pledging. At AMS, over 32% of the owner's shares are pledged. That means they've basically mortgaged a huge chunk of their ownership just to get loans. But why?
The answer is to fund the company itself. The business isn't making enough cash on its own, so the owners are borrowing money personally and then funneling it right back into their own company. This creates this incredibly dangerous loop where the company's funding is completely dependent on its stock price staying high.
And this whole setup, this total dependence on the stock price, it introduces a huge risk. It's called a margin call, and it could cause this entire financial house of cards to come crashing down.
Okay, this is the absolute crucial point. If the stock price drops in a big way, the lenders, they get really nervous. They can demand more cash. And if the owners can't cough it up, the lenders can just force sell those pledged shares on the open market. This pushes the price down even more, which triggers even more selling. It's a potential death spiral.
And the red flags just keep on coming. The company is paying interest rates as high as 15% on some of its loans. That's a rate that's usually reserved for really high-risk borrowers. On top of that, they have massively diluted their existing shareholders, increasing the number of shares 17-fold in just a few years to raise cash.
So after peeling back all these different layers, what's the verdict? Is this incredible growth story all sizzle, all flash and no substance? Or is there actually some real stake under there? So here's how the big money investors are looking at this. The growth story, it's real, but the financial structure holding it all up is incredibly fragile. AMS is what they call a high beta or a momentum stock. That just means it can fly way higher than its peers when things are good, but it's also exposed to way more risk. Its competitors, on the other hand, are seen as the safer, more fundamentally solid bets.
And really, this quote from an analyst report just hits the nail on the head. The market is pricing in absolute perfection from AMS. So the number one thing to watch is its cash flow. Can the company actually turn those huge orders into cold, hard cash in the bank and fund its own growth without having to use all these risky tactics?
Okay, before we wrap this up, just a very important note.
So, just to be super clear, this whole analysis is a case study, and it's for educational purposes only. It's designed to show you some financial concepts using a real-world example, but it absolutely should not be taken as financial advice or as a recommendation to buy or sell anything. So this whole case leaves us with a massive question, one that you should be asking for any investment you look at. Growth is exciting, of course, but it has to be funded in a sustainable way. So how do you tell the difference between a truly great business and just a great story? That, right there, is the paradox of profit.